Over the past 2 years, tech stocks have soared on the promise of artificial intelligence. But while names like Nvidia, Microsoft, and Meta dominate the headlines, a quieter story is playing out beneath the surface. One about discipline, cash flow, and survival. Because as AI mania sweeps Wall Street, a small group of companies are doing something radically different. They're growing without gambling. They're being called the bubble-resistant tech stocks, and they might be the key to navigating the next big market correction. Let's unpack who these companies are, what makes them different, and what their strategy reveals about building a business that lasts beyond the hype. We've seen this story before. Every technological revolution, from the dot-com boom to the crypto craze, begins with excitement, overinvestment, and then reality. AI is no different. By mid-2025, US investors had poured hundreds of billions of dollars into AI-related firms, pushing valuations to record highs. But now, cracks are starting to appear. Smaller startups are running out of funding, GPU supply is tightening, and energy costs for AI data centers are exploding. So while the giants continue to dominate headlines, analysts are warning that the AI bubble might be forming. And that's where a different class of companies comes in. The ones focused not on hype, but on sustainability. Let's talk about what makes a tech company bubble resistant. It's not about being small or boring. It's about having real profits, strong balance sheets, and diversified revenue streams that don't depend on speculative trends. Think of companies like Oracle, Cisco, Adobe, and Broadcom. They're not the flashiest names in the AI conversation, but they're deeply embedded in the digital backbone of the modern economy. Take Broadcom, for example. While Nvidia gets the headlines, Broadcom quietly designs the networking chips that make AI data centers run faster. It's booked with long-term contracts, serving everyone from Apple to Google, and its margins are massive. Then there's Oracle. Once dismissed as a legacy software giant, it's become a major player in AI cloud infrastructure through its partnership with NVIDIA. Unlike newer entrants, Oracle has predictable recurring revenue and low debt, meaning it can weather volatility without cutting back on innovation. And Adobe, despite being hit by fears of AI image generators replacing designers, has adapted brilliantly. Its AI tools now power the very creativity. Software people thought AI would destroy. That's what bubble resistance looks like, adaptability with cash flow. Now, compare that to the riskier side of the AI boom. Hundreds of startups are spending millions building models with no clear monetization path. Their valuations are built on projections, not profits. They depend on investor optimism, not business fundamentals. And when optimism fades, these firms collapse fast. That's exactly what happened in the early 2000s when the internet bubble burst. The survivors, Amazon, Apple, Microsoft, weren't the loudest companies. They were the ones that managed costs, owned infrastructure, and delivered consistent results even when hype cooled off. History doesn't repeat itself, but it rhymes. The AI correction, when it comes, will probably do the same thing: reward the disciplined and wipe out the over-leveraged. So why does this matter to business leaders and investors right now? Because the companies that are bubble-resistant today are also the ones building the foundation of AI adoption tomorrow. Consider this. Every AI model, no matter how advanced, needs storage, connectivity, and reliable software integration. That's Oracle's cloud, Cisco's networking, Adobe's Creative Suite, and Broadcom's Silicon. These aren't hype plays, they're infrastructure. It's the same reason why, in every technological wave, the picks and shovels businesses outlast the gold rush. When everyone else is chasing headlines, they're selling the tools everyone needs to survive. Another key trait of bubble-resistant tech? Cash discipline. After the 2022 to 2023 tech layoffs, many companies learned the hard way that growth at all costs doesn't work anymore. The new focus is on profitability, efficiency, and automation. Companies like ServiceNow and IBM exemplify this shift. Both are investing in AI, but in a targeted operational way, not by betting their entire future on one trend. IBM's watsonx platform, for example, doesn't promise the next ChatGPT. It focuses on secure enterprise-grade AI solutions that big companies can actually deploy. This kind of thinking is what separates real businesses from speculative ones. Now, from an investor's standpoint, here's what bubble resistance really means. It's not about avoiding tech. It's about owning the right kind of tech. Companies that can generate profits even when the hype cycle cools. Look at how these firms manage risk. They maintain consistent dividends. They reinvest in R&D without overextending. They avoid costly acquisitions purely for headlines. And they align their AI strategies with their core strengths, not trends. That's what keeps them steady when volatility spikes. But there's also a deeper lesson here for entrepreneurs and executives. In the AI era, resilience is the new growth. Companies that survive the coming wave won't be those that shout the loudest about AI. They'll be the ones that quietly use it to make their operations leaner, smarter, and more customer-centric. The bubble-proof mentality isn't about avoiding risk. It's about managing it strategically. It's knowing when to adopt innovation and when to wait for the noise to fade. Because when everyone is building castles in the cloud, the real value often lies in selling the bricks. In short, the so-called bubble-resistant tech stocks aren't just a financial category. They're a blueprint for how to build enduring businesses in a time of chaos. While the AI boom will mint new winners and losers, the ultimate success stories will come from those who combine innovation with discipline, growth with governance, and ambition with patience. So, if the market corrects, and it always does, these are the companies that will still be standing. Because when the bubbles burst, the solid ground doesn't disappear. It just becomes visible again.